Good morning. I'd like to call the meeting to order. At this time, I'd like to start out with the Pledge of Allegiance.
No, we'll just go right to Joe.
Oh, okay.
Yeah, we're not into that yet.
Oh, sorry about that. Okay, this morning, we're gonna start with the legal committee, with Joe Hardig.
Thank you. I'd like to call the legal committee to order. I'd ask for a motion to go into executive session to discuss a specific case. So moved, seconded. Julius, thank you. I'd also ask that all voting members of the board remain, as well as legal counsel and the executive leadership team. If everyone else would please just step out for a minute, or for a few minutes. Legal committee met this morning in executive session and no action was taken. Thank you.
All right. Committee's adjourned. Take time, please.
like to turn it over to Tim and Chris Mariani from Alesco.
Great, thank you, Bob. Good morning, everyone. It's great to be here with you in person and to see everybody on this great spring day. I know we've got a packed agenda and a couple of presentations related to the pension plan, so we'll make our comments as quickly as we can. You're familiar with me. I've been here for a number of our meetings. I did want to introduce our Chief Investment Officer, Chris Marioni. I wanted to bring him with us to the meeting so that he could have an opportunity to meet you and you could hear a little bit about Alesco and our investment philosophy and what's going on in the markets from our Chief Investment Officer. So I will keep my comments very brief. I normally do a little bit of a preamble, but we did have a positive quarter in terms of the equity markets. Investment was strong given the market upheaval we had a little bit related to the banking crisis, but most asset classes had a positive quarter, and you'll see that reflected in the portfolio performance. Chris will have some additional comments as we go through the review and at the end, but I'll start on page 1 doing a review of the asset allocation of the non-salary DB plan. The asset allocation has been consistent in terms of the equity exposure at 65.6%, right in the middle of your IPS range. So everything is within the IPS coordinates. The real return assets and fixed income bring the fixed income holdings to about 35% of the portfolio. The purple is inflation protected securities, and the remainder is fixed income at 25.5 and a little bit of cash at 2% at the end of the quarter, all within the ranges of the investment policy. Our equity allocation was also consistent during the quarter. We didn't make any changes after those adjustments we made last fall. At large cap at roughly 46%, 30% for international, so 70-30 domestic international mix. International has been the best performing asset class, so we've benefited from that exposure to international. The remainder pushed down the capitalization spectrum into small and mid. That was very consistent during the quarter. Page 3 is fixed income. Again, no adjustments to the fixed income portfolio in the quarter. After our adjustments to extend the duration in the fall, 5% each exposure to short-term government funds and short-term corporate bonds, the remainder in the intermediate core bond at 89%.
How far did you extend the exposure?
So this was last fall where we extended our duration from about 5.4 years up to 5.9 right now. So anything you want to add briefly about that, Chris?
Yeah, so that's much closer to where the market is overall at about a 6.3.
Okay.
And I can touch on this a little bit later as well.
Okay.
But when we think about interest rates right now, that can seem a little bit counterintuitive when you look at short-term interest rates, whether that's T-bills or money market funds, and those rates are so high, higher than longer-term bonds. But the reasoning behind that is that those short-term rates may not stay in place for very long, and so we've had an ability to lock in rates on the longer term that have come up, and we're expecting that we can hold on to those longer than what we'll see out of the T-bill rates.
But also taking advantage of some of the short-term,
Correct.
Yeah.
shorter duration.
Yeah, so
Right.
it was an adjustment up, not all the way
Yeah,
back.
we're experiencing that too on our reserves, on the T-bills.
And right now, the fixed income holdings combined are yielding 4.4%.
It's a negatively sloping yield curve.
That's exactly right.
Right.
Yeah.
Okay, great, thank you.
Yep. And then also, just real quickly for the TIPS portfolio, we've continued to keep that consistent split between long-term and short-term TIPS. Again, I'm looking for a duration of about 5.3 years on the TIPS portfolio. Performance on page 5 for the non-salary plan. In the quarter, you can see a gain of 5%, 1.6 million. Value at the end of the period, 35.1 million. So that's combining on top of the gains that we had in the fourth quarter to present a one-year return that's down about 5%, a little over 5%, a loss of $2 million. But you'll remember in the fall that was a roughly 14-15% decline. So we've had a very nice recovery in the capital markets and getting close to return that we're probably maybe down to maybe 3 or 4% on the one-year basis when we look at where we are now at towards the end of April.
It's also good to see during the quarter we outpaced our obligations, our withdrawal obligations, so that's fantastic.
Correct. So we got the 1 year down 5, and then what's really important too to focus on, while I know the 1 year numbers are very important related to your contributions, the 3 year numbers are very favorable. You've got a well over 10.5% return, 10.7%, $9.8 million. So this is something to think about from a diversification and a discipline standpoint, how the returns have benefited you being consistent in the market through 2 bear markets that have actually happened during that 3-year period. The COVID bear market and the one we had last year, still producing returns of close to 11%. So that's just the importance of staying invested in the market and how beneficial that can be. And then your returns going back to the inception, 5.4%, $5.8 million at the beginning of our relationship with you in the beginning of 2020. If we move to page 6, just a quick look at this. I don't want to spend too much time on this, but want to look at the returns that we saw in the quarter in terms of equities. 6.26%, and that was a little bit behind the All Country World Index, which is the global benchmark we look at to compare equities. That's a very large cap, market cap oriented benchmark. Large cap stocks were the best performing asset class, 7.5% on the domestic side, but you'll notice international up 8.5%. So this is just this transition that we're seeing into international assets after underperforming for a number of years. So that's a positive sign we get from the diversified portfolio. On the 1 year basis, we were down about 6.2%. That's ahead of the global benchmark at the top as a total comparison of portfolio, and that's in part because the asset classes, value and mid-cap actually, and international, actually outperformed S&P 500 type large cap assets. So again, showing you the benefit of having a diversified portfolio and not all your eggs in one asset class. Emerging markets struggling a little bit in the year just because of the situation in China. As they're reopening, we're starting to see that market perform a little bit better. Over the last 3 years, we've outperformed the All Country World Index, again, because of the performance of value and small cap stocks outperforming large cap. And since our relationship started in 2020, large cap has been the best performing asset class, but due to the weightings that we have in the portfolio, we've been able to outperform that All Country World during that time frame. Page 7 is just the transition between value and growth. We've talked about this in a bunch of previous meetings. You can see that's continued over the past year as interest rates have moved higher. We have a nice complement of value stocks in the portfolio that's taking advantage of that versus overweighting in growth, which has underperformed as interest rates have declined. So just in the interest of time, I want to go through the remainder of the portfolios, but just to show you, or the pension plans, but just to show you that the allocation and the performance is similar, which is the case. The salary DB plan in tab B, page 10, equity at 65 and fixed income and real return at 35%, and that 2% cash. On page 11, you can see the equity allocation is the same, 70-30 between domestic and international, just as in the non-salary plan. Similar on page 12 for the intermediate bonds and fixed income, that exposure roughly 10% and 90% in the core bond. TIPS portfolio for the salary DB plan is the same, mixed between 65-35 roughly between short-term and long-term TIPS. The performance on page 14, again, you have that gain of 5%, 1.6 million, and the loss of 5.29% in the 1 year period, similar as in the non-salary plan, a loss of $2 million. Your gains over the 3 years, the same, 10.7, and then 5.42 and $5.7 million gain back to inception. Page 15, same asset class performance in terms of that. I did not highlight on the non-salary plan, and I should have, just to look at the fixed income returns and how the duration that we've had, the shorter duration, and this is looking at the 1 year number, middle of the page in fixed income. Over the 1 year period, a loss of 3.47%. The Barclays aggregate was down almost 5%. So having that shortened duration as interest rates were rising helped on a relative basis in terms of performance. And we've outperformed just slightly over the 3-year plus back to inception time period. So just wanted to highlight that for you on the fixed income. So having that movable ability for the duration does make a difference in terms of performance, and that's kind of what we're looking at currently in making some changes there potentially. On the DB plan for Utica, again, the same allocation overall, 65-35, same for the equity allocation, 70-30, short-term bonds, long-term corporate bonds, or short-term corporate bonds and bond allocation the same, and TIPS as well, all consistent through the 3 plans. And you can see the returns as well, 5% just shy of that for Utica, loss of 5 in the 1-year period, 10.6 and 5.4 for the inception, all incepting on January 1st of 2020. And similar performance for equities, fixed income, as we look at the different asset classes. So
And I think it's important to note too, if you all recall back in, January 20, we made this switch, was the, everything was just starting to unleash on the COVID side. And switching, I believe, to this model of an asset allocation with a sliding IPS and giving the investment advisors the opportunity to operate within that range rather than sticking to the philosophy type investment that we had prior to that, I think has really paid off for us. So has not gone unnoticed. Thank you.
thank you. And with that, I'll turn it over to Chris for maybe another 5 minutes or so of comments related to Alesco and our thinking on the capital markets now.
Great, thanks. Thank you for welcoming me in today. I have a few main themes that I'd like to discuss that are driving markets right now. First is inflation, and then second is the impact that's having on the U.S. economy, and third is the valuations within capital markets. So if you can turn to page 27 in tab D. There's a graph here of inflation on the top of this page, and that darker green line represents CPI, and we can see over the past several quarters how quickly that has been coming down. And so that's, of course, good progress. That's been what the Federal Reserve has been targeting to get that inflation number down. That other green line, the lighter one, is core CPI, which removes food and energy prices. Those are notoriously volatile. We know that just from gasoline prices, for example. And so it's very common for economists to take out those elements to review, what are the underlying forces within CPI. And that gives sometimes a better measure of that. What's interesting in this graph is that there was such a large difference, if you look back a couple quarters, between the core CPI and the headline CPI. That has gone away. So really what that's telling us is we were in a stage where energy prices and food prices were accelerating faster than everything else. And that's no longer the case. So when we think about what are the main drivers of inflation right now, because inflation is the big story that's really driving everything else. Within inflation, the major components are food, energy, and then core services and core goods.
Well, we all felt it when we were paying $1 an egg.
Exactly,
Yeah.
right, and that has largely gone away. And actually on page 28, we can see that. We have the top graph breaks down those 4 items, and we see food items in purple is basically at 0. So that really has flattened out. And we see energy that is now below 0, so energy prices are in decline. I mean, it's sometimes hard to recognize that, but gas prices are down, oil prices are down, and that is bringing down inflation. And then there's core goods, which that was really what had sparked a lot of this initially when consumption patterns had changed coming out of COVID, or really going into it, where people were just buying more goods instead of services. And then we had all the supply chain issues. That has largely gone away as well. There's actually a graph at the bottom about supply chain pressure, just back down to really a 0 level. So, all of the issues from that we've seen through the pandemic have really resolved at this point. What's left are the core services, right? That's what's driving inflation at this point. And there's 2 reasons for that. One is those tend to be more labor intensive, and the job market is really tight right now. And so anytime that is requiring people to provide a service, right, those prices are just going up more than everything else. The other element of that, though, is shelter prices, which go into services as well. And the housing market you know, has been a bit haywire, to say the least. And what happens with that, though, is that these shelter prices, they move with a lag, right? So they're not as real time as everything else that you see in CPI. You think about a rent on an apartment, right? That resets once a year. And so that's gonna be steady until that resets, and then it's gonna jump up. That's what we're experiencing right now with the shelter prices, is that ratcheting up effect coming from housing price increases that occurred last year. And so, you know, that's holding things up right now. That effect, based on what we're seeing in the housing market that has roughly stabilized, we'd expect that to come down as well. So we've got this last driver of inflation that's pretty high. The shelter part of it, I think from some technical reasons, is largely, you know, going to start coming back down too. So overall, we look at inflation, it's a pretty positive picture. It can change pretty quickly. We've seen that lots of times. You know, energy prices specifically could make a change there. But the Fed's interest rate increases are making a big difference, right? That's really the key point here. So then the next part is, how does this affect the economy? We can see that on page 33, right? So the Fed is increasing their interest rates. We expect that to be coming to an end relatively soon. But that's because they are having an impact on the economy. And so what this graph on page 33, there's a lot going on here, but if we can just kind of step back and look at the big picture, green is good, red is bad. We look back to early 2020, we saw, you know, those months when COVID was first hitting, where everything was red, and then it quickly turned to everything being green. After that point, you get this more patchwork of colors between these different economic indicators. That's more typical. It's more normal to have some things doing well and others not. Right now, we're in a place where the economy is painting a very mixed picture. We're seeing consumers holding up very well. Again, the employment market is great still. But we're seeing the impact of higher interest rates on business investment, right? You have businesses that are not going to be, you know, investing in capital at this point. And that's because that's more interest rate sensitive. So we would expect those things to show the first signs of slowing down from rate increases. That's exactly what's happening. So when we look at GDP growth overall, that just came out yesterday at 1.1% for the first quarter, pretty low number. And that's exactly what this graph is painting, right? Everything is kind of mixed, moving along a little bit slowly. You know, not great, but not falling off a cliff either. And so when we think about what does this mean within our portfolios, if you can turn one more page to page 35, you know, the economy, whether it's heading for a recession or heading for a slowdown, right? Those can be different things. And even if we are going to a recession, it doesn't have to be catastrophic, but there are some things that have to be worked out in the economy. What we're looking for in a situation like that is we want to be careful not to be overpaying for the assets in the portfolio. And so on page 35, we have the valuations across different segments of the capital markets. And if you look at the dark green bar all the way on the left, that represents the whole US stock market. And that diamond shows that it's a little bit higher than that black bar, which is the median. So overall, pricing in the US stock market is about average. If we look within that, we see small cap stocks are at the low point of their range. And Tim had mentioned we have extra in small cap stocks right now to reflect that. And then when we look at value versus growth, we see growth stocks tend to be priced above average, whereas value is about average. And so we have more in value stocks that should stand to benefit from the disparity between those two segments as well. And then the other parts of this graph are international markets, both developed and emerging, and we see a very similar pattern there. Overall, we see international valuations are lower than in the U.S., and the patterns, the components within them favor both value stocks and small cap stocks. So, you know, while we don't try to forecast exactly where the economy is going, and even if we could, the reactions from the stock market can be pretty unpredictable as well. What we're looking at is, you know, when we can buy assets that are priced better than others, it provides more of a a buffer or a cushion against unexpected events. And that's the way that we have the portfolio positioned today.
I have one question. Just for my, does AI have a taken part in this artificial intelligence?
Yeah, that's something, the question was about AI, and we're definitely talking about that a lot. I'm not sure that's having much of an impact on the market today, besides some specific companies that have handled that, you know, are better and are getting a tailwind from that, and some that have gone the other way. But, you know, we're looking at that internally in terms of, you know, what does this mean, you know, for the investment industry and for us as a business, and how can we take advantage of that from a productivity standpoint. And I think, you know, we're hardly alone in that. That's a very popular thing to be looking at right now.
Two quick questions, and they may be redundant. Approximately, what is the current return of the fixed income portion of the portfolio about?
So overall fixed income, when you include the tips and the real return, tips and the regular fixed income assets, is how I would answer that question. I do have that here, I want to give you a note on that. So overall, the yield's gonna be about 4.4% is where the yield is related to that. I've got it over here, actually, I wrote it up here. I'll make sure I get the right number. So overall, it's 4.4% is the yield right now on the fixed income portfolio.
And the current return, the income divided by the price, meaning you're quoting me like the yield to maturity.
Correct.
Yes, so, but I guess my question is, what could be helpful to paying the outgo is the income divided by the value. Any handle on that?
Do you have a sense of what that would be, Chris? I mean, I've got the duration, the yield to maturity, but
Yeah.
I don't think we'd have to get back to them on that number, right?
Yeah, so just making sure I understand. So looking at the income.
That the fixed income portion of the portfolio is generating the money
Oh,
from the
okay,
coupon
okay.
on the
Oh, the
bond.
coupon compared to the
Yeah.
yield. Right. Well, I don't know that number offhand. That would be lower than the yield maturity.
Yeah,
Right,
obviously,
right.
but Brian pointed out, which is a good thing, that we're meeting the expenses. And it would be nice if the coupon could contribute to the expenses.
Right,
Yeah.
Yeah, and generally, we look at that on a total return basis. So, you know, looking at the interest income as well as, you know, any capital appreciation or depreciation, which we saw in the first quarter. There was a pretty good appreciation from the bonds, returning about 3% over 3 months.
And the next question, one of the issues that the SEC is looking at, and I've brought this up before, and I'm not trying to beat a dead horse here, but liquidity risk management, and you use ETFs. A lot of these things are very, very liquid. Okay, but on some of them, have you done the study taking all of the RIA's assets, all of the shares, and compared it with the average daily value? Meaning if you own a particular ETF and all of the money you manage, you look at the aggregate and say, well, we own 2% of the daily volume, or do we own 40%? You guys do that, correct?
We do.
Yeah,
Correct.
yeah. And for the ETFs that we're using, they're very large funds. We're generally in a pretty small portion of those. I can't quote the numbers off the top of my head, but we can get those if that would be of interest to you.
Well, no, just so long as you
We
feel
absolutely
comfortable
look
with
at
it.
that.
you know.
Yeah.
And the ones that would be of issue wouldn't be the QQQ per se, but it would be like the emerging market, or
Right.
it would be the high yield fixed income.
Mhm. Yeah.
Because that's where the problems come in, or
Right.
the small caps also.
Yeah, that's probably more so than, and even emerging markets. The emerging markets fund that we use is really gigantic, so that's pretty good. The small cap one is also one of the largest ones out there in the market.
Good, it's the high yield.
Yeah, which we don't have high yield in the portfolio right now. We do have, it's investment grade corporate bonds that are in there. That's also a very large fund. So, you know, I think we're in fantastic shape.
Good.
As far as that goes.
And related just to our selection of funds, I know when we talk about that at Alesco, if there's a new fund that's, you know, has a interesting look to us. We certainly never invest into it until it has a significant amount of assets in it, because we're very concerned about that very issue that you bring up in terms of the liquidity and how much percentage we might own of it if we're moving into a new fund because of the size of our firm.
Yeah, and I'll tell you from just that part of my job has become so much easier over the years as these funds have become more popular. Right, that used to be something that we had to pay more attention to, but now the sizes of these funds have increased, the availability of them, the different portfolio construction methods. We have way better choices now than we had, say, 15 years ago.
Yeah.
Very good. Thank you both, appreciate it. We now have Greg.
Yeah, at this time, I'd like to turn it over to Greg Stump, the actuary from Boomershine.
And that is me. Good morning, everyone. I have to tell you that the first thing I thought when I walked in this room was, I don't have enough copies. And I apologize for that. If this is my first time here, I didn't know it was a large group. But I do have 10, so I'll send 5 each way, and and I will read off the screen. And Brian does have an electronic copy of this, just as of this morning. More. Is that not quite enough for everybody? I will bring more.
I have it on the screen. I can share.
Okay. All right. I will bring more next time. So I'm Greg Stump. I'm with Boomershine Consulting Group. We are the actuary for the pension funds as of last year. You had another actuary before. He retired. And from what I understand, I don't think he did presentations at these meetings, which is unfortunate because it's very important. So I intend to be here once or twice a year, go over this stuff with you. There's kind of 3 components of the pension systems. There's the investments, we just talked about that. There's the administration, which a lot of it's done in-house. We help with some of that. And then there's the actuarial stuff. So what we do is, for all of the plans, we collect data once a year. So it's always a snapshot measurement. We don't do updates every quarter or something like that, but there's a snapshot measurement, that's the valuation date. We collect data on everyone who's in the plan, whether they're receiving a benefit or actively employed, or not employed, but will get a benefit when they reach the eligibility age. And so we measure the assets versus liabilities, which is all based on the calculations that I'll talk about here. And we also help with the financial reporting. So that's, as of March 31 every year, we're doing that right now. So, first and foremost, I would like to answer any questions that you have along the way. So if you do have something, please shout it out. That's the main reason I'm here. But my topics are, a little bit of background, how this all works, what we do, the funding history of the plans, current status, funding policy, big topic for today, I'll tell you, future outlook of funding, and then some recommendations at the end. So, funding background, and this is just a couple slides that I'd like to go over just to have people understand how this all works, because I do this every day, but you hear about it once a year, if that. So it's a good refresher. So this is the way it all works. I've boiled it down to just a couple of slides here. When somebody enters the plan, when they're hired, we don't need any assets. Now the plans are closed, but this in general, we don't need any assets for them because they haven't accrued any benefits yet. But they do have an annual cost. So an example might be it's 8% of their pay. So maybe $3,200. All the way to the right, when somebody retires, that cost goes away. The benefit's fully accrued. There's no more benefit they're going to achieve once they get to retirement. But you have to have a pot of money to pay them for the rest of their life. So that's why that example's there. Assets needed, just an example, $300,000, no more annual cost. Someone in the middle of their career, whether it's 5 years in, 15 years in, you have both. They have accrued part of a benefit, so you do have to have some assets set aside for them in the fund, and they still have that annual cost. But if it's a percentage of pay, it tends to go up over time. So maybe it's $4,500 now. So that's how it all works. That's what we do. We do it for every person in the plan, and we put them all together, and that's the total, which shows up in the valuation report. The definitions there are, assets needed. We call that the actuarial accrued liability. Fancy term. That's just, how much assets do you need for that person or this person. The annual cost we call the normal cost. So as you look at you know, the graphs I have here, or if you take a look at the valuation report, when you see that normal cost, it's just the annual cost for benefit accruals. So every year and over time, and especially every 5 years when we review all the assumptions, we look at all of these things. So here's what affects the plan funding. Investment performance, very obvious. If you get more than you expected, it helps. If you get less, it hurts. Salaries, if you have a salary-based benefit, right, so that's one plan but not the other. If you have more, you know, higher salaries than you thought, than you projected, that actually hurts the funding. It's good for the employees, but it hurts the funding because you weren't counting on the ultimate benefit being that high. Retiree longevity, meaning how long people live. People are generally living longer, you know, excluding the last few years, but over time, over decades, people are living longer. But that actually hurts plan funding. If people live to be 90 and 95, and we're funding for them to pay them until they're 88, well, that would come up a little short. Retirements, if people retire earlier than we thought, or you know, we have more retirements than we thought, that generally hurts because we don't have as much time to fund the benefit as we thought we would have. And terminations, you know, people leaving, quitting for whatever reason. If you have more than expected, it's kind of a bad thing, you know, to have a lot of turnover. But in terms of what we do, the actuaries, it helps. If somebody quits, you don't have to fund their benefit anymore. It just stops. So that's the background. So just keep in mind that those are the things that we always look at, you know, as we do all of our calculations. So the next section goes over the funding history and the current status of the plans. So when we talk about funding, I like to put it into two figures. There's the unfunded liability, you know, how far away are you from being, you know, completely fully funded, and then there's the funding ratio. A lot of people will look at that funding ratio and just draw some kind of conclusion in their head, that's good, that's bad, but that doesn't tell the whole story. You really have to look at both things. So what's happened over the past 5 or 6 years is the unfunded liability went up, now it's down. It does fluctuate a lot, but the funding as of the last valuation was 91%. So by the way, that snapshot date, the most recent one is April 1, 2022. Even though we're past April 1, 2023, it takes a couple months to do the valuation, so we don't have those numbers yet. The non-salaried plan almost looks like the same exact picture because it's followed a similar pattern. But you know, the unfunded liability is lower now than it was in 2018, and the funding ratio is higher. So they're on the right path. But when I look at these graphs, the first thing I think of is what's going to happen in the next 5, 10, 20 years. And I'm going to answer that for you. But before I do that, let's talk about a couple other things. The current status of the plans. So there's some figures at the bottom. These are all from last year's valuation reports, which were published a while ago. For the salaried plan, you know, and again, it's just the snapshot date, 37 million in assets, 41 million in liability. Remember, the liability is that the assets needed that I went over with that little timeline. So $4 million unfunded, and anytime you have an unfunded liability, meaning you're not exactly 100% funded, it's not a bad thing. It's just part of the life cycle of a pension plan. You're going to have a portion of your annual cost of the contribution in that red section. If you're exactly 100% funded, the red section goes away completely, and all you're left with is the normal cost. And remember, the normal cost is just a portion for each active employee. So well over half of the contribution now is working towards 100% fund. And it's the same story with the non-salary plan on the next page, and very similar numbers. There's a typo there, there's a missing digit, but the unfunded liability is 6 million there. So, but the amortization is going to be a big part of it until you get really close to 100% funded, and then that goes away. So, as I mentioned earlier, funding policy is a really important topic. You have an investment policy statement, I assume. There's something similar on the actuarial side. There's an actuarial funding policy that I can provide for you. It's a pretty brief document, but it just sets the guidelines to how the plan is going to be funded. So I'll mention that a couple times later, but the actuarial process works like this. We have to set assumptions to determine the annual cost. So you have an employee in the plan. We have to assume when they're going to retire, what their benefit's going to be, and how long they're going to live. Basically just boils down to that. There's other assumptions in there, but that's what we have to figure out. So we have assumptions from the prior actuary. We don't have enough data yet to develop our own assumptions, but we will next year. And then we adjust the cost each year as experience emerges. And when I say experience emerges, it's that whole helps and hurts chart that we went over. So we look and say, all right, well, there were more retirements than we expected. That brought the cost up a little bit. There were more deaths than we thought. Well, that brought the cost down a little bit. And, in net, that's how the cost changes year over year. But I can tell you, by far, the biggest factor is the investment performance. That will outweigh everything. Not every single year, but when you have a really good year or a really bad year, that will completely outweigh all of those other things. And that's what's been going on recently. And then we adjust the expectations every 5 years based on actual plan experience and future outlook. And that's something we call an experience study. I'll talk to you about that next year. But that's when we fine tune the assumptions. Like for now, for example, everybody is assumed to retire at the same age. That's probably not likely. We'll take the actual data and see when they actually retired, and we'll come up with a table that's, for example, 10% of people go out, the first day they're eligible. 25% go out at age 65, because they can get Medicare, et cetera. So the assumptions are a little simplified right now. So that's something we'll get into next year. So the last part before the future outlook is just the current funding policies. So the funding policy is made up of a few different things. There's an actuarial cost method, and I won't go into what these different things mean, but one's unit credit for the non-salary plan, one's called entry age, which spreads out the cost over the career of somebody. They're both fine and appropriate, but that is part of the policy. There's no asset smoothing. I probably should have put that in bold because that's really a big topic for today. But if you did have an asset smoothing, which I'll explain, that would be part of the policy as well. The amortization ranges from 10 years to 30 years. I think that the center has been very good at funding it appropriately, mostly using the 10-year amortization. And the assumption review, as I just mentioned, it's probably never been done, which is why you have all the simplified assumptions, but we'll get to that next year. So some possible changes, we'll talk about asset smoothing today. I think a more refined amortization policy would help, although I don't have any complaints about what's been done in the past and what's being done now. And as I said, there's assumption review will be next year. So the future outlook is we're going to look at two different things. There's the funding, which is those two pieces I talked about, the unfunded liability, the ratio, and the contributions, which is going to be broken down into two pieces. There's the normal cost, which I mentioned a couple of times today, and there's the amortization payment, which is that red section of the pie chart. It's all kind of color coded. It's all the red stuff in here is the amortization and the unfunded liability. So here's a baseline forecast. Now, a couple important things to point out here. This starts in 2022, so at the last valuation on the left, goes out 20 years, and the same thing on the right-hand side, that's the cost portion. Yeah, thank you. Most important thing to realize is it will not look like that. If we take a time machine 20 years in the future and look back, it won't be smooth like that. It never is. So this is just a best estimate based on what we know right now. It does include a negative 6% return for fiscal year 2023. It wasn't quite that bad. It was negative 5 point something for each plan. But we just rounded up just in case there's other unfavorable experience. And that negative 6% return relates directly to that sharp increase in the red line on the left. So without asset smoothing, you have a negative 6% return. Now we're assuming positive 7%. So that's a 13% loss. It's not a 6% loss, it's a 13% loss. That's a pretty sizable number. If you recognize all at once, your unfunded liability shoots up from less than 4 million to over 8 million. So more than doubles in 1 year, which is a lot, which is why most plans use asset smoothing. But over time, it'll go down. You make a payment towards it every year, and you become almost fully funded at the end. The cost side of things, generally it follows the same pattern as that red line. So you have the normal cost, which increases a little bit over time as people accrue more benefits. And then you have the amortization, which jumps way up when the unfunded liability jumps way up, and then kind of settles down as you get closer to 100% funding. That's what we're set up for right now, pending the valuation results. When we're done the full valuation, those will move a little bit. It's not, like I said, the investment performance is going to outweigh everything else. So that's what it looks like, and that's what I'll do the asset smoothing and then talk about the non-salary plan. It's a similar story. The next page shows us, well, what does it look like if we adopt what's called 5-year asset smoothing? There it is. So the way this works is, and by the way, 5-year asset smoothing is the most common way to handle the actuarial evaluation. I would say well over 90% of pension plans out there use 5-year asset smoothing. Certainly well over 90% of my clients do. In fact, I only have 2 clients that don't, and the reason they don't is because they only invest in fixed income. One's a federal plan, and one's a state plan in Virginia, so they don't even invest in any volatile assets. So the way the asset smoothing works is, instead of recognizing that loss, that 13% loss all at once, you recognize it over 5 years. One piece right away, 4 more, and you eventually have to recognize it all. So when I say recognize, what does that mean? That means that it doesn't go into the cost equation right away, right? Obviously, it's part of the assets, it's there, it happens. But you don't pay for it right away. What you do is you say, all right, let's recognize 1/5 of it, and then another fifth, another fifth, another fifth, and then as those years happen, you put in another layer. So maybe maybe fiscal '24 will be a gain, so that'll offset a little bit. Maybe the next year will be a gain, that'll offset. Maybe the following year will be a loss. So you have these layers, and it does exactly what is called smoothing. And it really should be called contribution smoothing. You can't really smooth assets. The assets are what they are. But it smooths the contribution. So instead of jumping up from this to the next one, which is really, really high, you go up there in 5 steps. So my recommendation in that category is, I think you should adopt asset smoothing. But if you didn't, I wouldn't object. It's fine. I think with the experience we've had in the last couple of years, it kind of makes a lot of sense now. There are periods of time sometimes where your returns are between 2% and 11 or 12%. It's not that much of a fluctuation, but recent years we've been getting like 20%, negative 5%. So that really speaks to why asset smoothing is so popular. I could get over the non-salary plan, but this story is exactly the same. The without asset smoothing, you have that jump from 6 million unfunded up to a little over 10, so not quite double. And then the jump in the cost, the amortization cost. But with asset smoothing, which is the next one, it happens gradually. So the asset smoothing, honestly, is the main thing I wanted to talk to this group about today. Looking at the reports, because when we start with a new client, we perform the last valuation, make sure we get the same answer the last actuary got. We did that. We look at all the assumptions and say, okay, well, some of these are going to have to be updated, like the simple retirement age. But another thing we look at is asset smoothing. So we looked at it and we thought, wow, no asset smoothing? So it was a little surprising.
That's something we can certainly talk about internally, and we'll get back to you on that.
Okay, good. Yeah, I know. Sorry, I know I'm taking too long.
We got like 5.
Yep. So that's the end, really. So plans are well funded. Consider the asset smoothing we just talked about. I will come back with an assumption review of everything next year. And actually, I will ask for more time that day.
That's fine.
Because that takes a little longer. And then funding policy is not anything urgent, but something that we should definitely work on.
Yeah, if there's a point too, we can do a separate, it doesn't have to be combined with the pension, we can always have you in.
Okay. Yep. Thank you. That's all I have.
Any questions for Greg?
The term, when I look at this, I see basically the term fully funded at the present is safe to say.
Well, it
You
depends
have
on
that
what
idea.
it depends on what you mean by fully funded. Some people will say fully funded means you're 100% funded. So that's
No,
not the case.
That's not,
Other people will say fully funded means you're putting in what you should.
yes, that's.
And yes, that is the case.
If we just keep it north of 70, 80%, we're in good shape.
Okay.
So basically what we can say is actuarially, what's in there and what we're contributing will meet the future obligations.
Yes. You're definitely doing the right thing funding wise.
Good to hear.
Any other questions? That concludes the pension committee meeting.
Great, we'll take a 2-minute break and we'll go into audit finance.
At this point, we're going into our Audit and Finance Committee meeting, and I'd like to turn this over to Linda Beata.
Thank you. Good morning, everyone. We're going to begin with a motion from John Mela.
Oh, we are.
Was different. I put an outline together for everybody. Just so you know, this year we did a complete RFP for our coverages. And as it turns out, we're remaining with the same broker, which is RPS, and the 3 same insurance carriers. The good news is, compared to the marketplace, we did very well. Our overall increase for the 3 layers of our coverage is 6.1%. And that is way below what's happening in the current marketplace for both business and personal coverage. The second page is basically the summary. Last year, we paid $1,452,000. This year, for the 3 contracts, it's $1,540,000. So, all told, I think we did pretty well. Anybody have any questions?
Say a motion to bring it to the board.
Can I have a motion to bring it to the full board? Monty, second. Tina? Thank you. All those in favor?
Well, thank you.
Thanks, John.
Next, we have resolutions. Caitlin's up.
Good morning, everyone. So I have 4 resolutions today. We will start with the micro market and vending services resolution. This is a revenue contract. This request for proposal was publicly let on January 11th. We sent out 15 proposal packages, 3 of which went to minority and women-owned business enterprises, and an additional 12 packages were requested. On February 8th, we received 3 proposals, and the evaluation committee determined that Servomation Refreshments offered the most advantageous proposal. They offered, Sorry. They offered 33.85% of gross sales, or the minimum monthly guarantee of $4,000.
Can I have a motion to forward it to the full board? Julius, second. Darlene, thank you. Motion approved.
So next resolution is for the risk manager for workers' compensation contract. This will be paid for with operating funds. So this request for proposal was publicly let on February 2nd. We sent out 52 proposal packages, 16 of which were sent to minority and women-owned business enterprises, and additional 12 packages were requested. We received 5 proposals on March 2nd, and the evaluation committee determined that Crown Risk Management offered the most advantageous proposal. There is a full 30% MWBE goal on this contract. So it's my recommendation that the board award the risk management for workers' compensation contract to Crown Risk Management for a full 5-year term.
Any questions? Can I have a motion to move it to the full board? Neil, a second. Monty? Motion.
Okay.
Any objections? All in favor? Motion approved.
Okay. This resolution is for the purchase of 13 paratransit vehicles. This will be paid for with grant funding, a mixture of federal and state funds. So, Shepherd Brothers holds the New York State contract for these vehicles. We are looking to move forward with a purchase of 13 dual rear cutaway 11 passenger paratransit vehicles. They offered the New York State contract pricing of $126,691 per vehicle. So we're looking at a total of $1,646,983 for the total purchase. So we're looking for approval to award to Shepherd Brothers.
Any questions?
When would you get them?
That's a great question, Lynn.
I believe the lead time is a year right now.
Yeah.
You're gonna get 13 all at once?
I
We
believe they
typically
normally
on
come
the,
all
Yeah.
at once, yeah.
on the smaller ones, they come in at a bulk shipment, yes.
Yeah, there's a chassis delay right now, so that's why it's gonna take a while.
When we order the larger, when you're talking, the 35, 40 foot buses, those come in periodically throughout the the build process, but the smaller cutaways come in all at once.
Any other questions? Motion to move it to the full board? Tina?
Yeah, Tina-
We
Tina
need
wants that
some
one.
new buses.
Second? Monty? Any objections? All in favor? Motion passed.
And lastly, I have the resolution for the purchase of replacement fare boxes. This will be paid for with 100% state dedicated funds. This is the resolution for the information that Chris brought last month to purchase the new fast fare boxes, getting credits for our Odyssey fare boxes. All of that information was on page 2 of the resolution. So this is a sole source purchase through GenFare due to the proprietary software. So we're looking for award for $3,561,478 to GenFare.
Question, the fare box, that one on the bus?
Yes.
That's not working right now.
So
Yeah,
this will.
it's gonna be a great move for us. Go ahead.
Upgrade.
Yeah, so
Upgrade.
this will upgrade that entire system to be one unit, so it'll look like the larger fare box that stands on the floor, and the module on the side will be removed. So everything that module can do is now incorporated into one fare box. So it allows us
The option to add other things in the future too.
and streamline the process. It'll accept Apple Pay, Google Pay, so it'll do more options than even what the unit was able to do right now. So that'll allow us to implement that, and this award will allow us to start the process to hopefully be installed by August.
Yeah. I want to thank Chris for his work on this. He did a lot of meetings with GenFare. We had Zoom sessions, we had in-person meetings in Albany. And they really stepped up too. So this is a good thing for Central.
Any other questions? I need a motion to move it to the full board. Julius? Second, Darlene. Any opposition? All in favor? Motion passed.
Terry
Thanks,
Spraker
Kate.
Yeah,
has
thank
the-
you.
Good morning, everyone.
Good morning.
Back in February, I came to ask your permission to change a contract for Greyhound bus lines down at the RTC. They were reducing their outdoor space where they store their buses and their pickup and drop-off area. After that award, they came back and asked us to retro the date from March 1st of this year to December 1st. So I'm looking to ratify that and go back to December 1.
It's a simple contract amendment, that's all. It does need board approval, so motion to bring it forward.
Approximately how much money?
$280 for the month, so if we go back, it's 2,000 and change.
It's because of the long-term nature of the contract, we have to bring it to the board.
Was this part of just service adjustments? They don't need to lay over as much, or is it reduced?
No, they severed their ties with Adirondack Transit Lines, and now they have to share space within the center, and to use the outside space, they reduced by half. So, Adirondack Lines will be using the other half,
And paying
and that
for
was
that.
part of the
Okay.
resolution in February as well.
Gotcha. Thank you. Monty, you had a question?
No, I was going for the approval.
I need a motion to forward it to the full board. Monty? Second?
Should see a
Tina?
smile on your face.
All in favor? Motion passed.
Thank you.
Thank you.
Thank you, Terry.
So there's no other items on the agenda. Next month, we will bring draft financial statements for March 31st, 2003. I won't be here for that meeting. Melissa Brim will be doing the financials. And
Does that mean I have to do your portion?
You're up, Bob.
so that concludes our agenda.
At this time, we're gonna go into the full board meeting.
We just need to take a 2-second break so we can adjust the video.
this time, I'd like to open up the meeting and let it be known that this meeting is both the regular board meeting and the annual board meeting. And at this time, I'd also like to do the Pledge of Allegiance. I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
And I'm going to turn the meeting over to Brian at this time.
Thank you, Mr. Chairman. Just a quick couple of announcements. I'd like to ask for a moment of silence. It's with deep sadness that I inform you we had a long-term employee. It was a Syracuse supervisor here. His name is Terry McGriff. Passed away unexpectedly on April 2nd. Terry joined us back in 2005, as a part-time operator, came through then as a full-time operator, worked his way up into the supervisor role. This was very difficult for his family. It's very difficult for the Central family. So I'd ask right now just for a moment of silence, please. Thank you very much.
He's on his way.
Okay, so we're going to wait on these two
Okay, today we have a quorum present. Our next meeting date is May 19th. This is due to the Memorial Day holiday weekend.
Yeah, so please note that that's a week earlier than normal.
And at that time, we're gonna have a governance committee meeting at 9 a.m., audit and finance at 9:30, regular board meeting 10 o'clock. At this time, I'd like a motion to approve the regular minutes of the March 24th meeting. Julius? Tina? All those in favor? Motion carried. At this time, we're gonna hear the Chief Executive Ryan's report.
Thank you, Mr. Chairman. First up on the docket, I'd like to just take a second to recognize a long-term employee that's retiring after 21 years. Tony Battalana has been with us since 2002. He came to us with a multitude of body shop experience prior to that. Tony brought us several ideas throughout the years, removing encumbrances, especially when you're talking about our clear coat painting and single stage fleet painting. Save time, save money, and as you know in this business, saving time is money. So that's fantastic. I'd also like to point out that I have a little bit of a history with the Battalana family. It's a neighborhood thing, although I do have to point out it was with Tony's younger brother, not so much with Tony. So right now I would like to have a round of applause and thank Tony for 21 years of service. If you'd like to say a few words, Tony, you're welcome to do so.
Thank you all. It's been a long, strange trip. It's all I gotta say, just thanks. It's been a hell of an experience.
Well, thank you for your service and thanks for keeping the buses looking great.
Thank
Great
you
job.
guys. Thanks for I appreciate the opportunity that was presented to me, and I took full advantage of it.
Enjoy your retirement.
Thank you.
Okay, next. Okay. We'll come back to that. Next, I'm just going to go into my report here briefly. It was included in your board packet. I would like to also offer a reminder that after this, we are going to go right downstairs into our RPM program, which is our quarterly recognition of the employees, where we hand out some awards. We talk about some community service to the company and their longevity. And we've got a nice lunch, so if you're able to come down just to say hi, that would be fantastic. If you're able to stay for lunch, we've got Brooklyn Pickle brought in some great food, and you guys can enjoy and mingle and have a sandwich. Before I get into my report, I'd like to talk a little bit. Central, one of the things I really want for this company is for us to get active and involved in our community. We were able to take part in the honor flight that took place a couple Saturdays ago. Actually, it was last Saturday. Chris has got some pictures up here. I would like to thank Casey. There he is, walking in. Casey did an amazing job grabbing us some photos. Actually took part. Casey, would you like to talk a little bit about your role now in honor flight?
Sure.
All right.
Good morning, everybody. I was given the honor and privilege of flying with 81 veterans, 81 companions down to Washington, D.C. With Honor Flight Syracuse. We spent the day touring all of the military memorials from the World War II memorial that you see here. That's all the vets and their guardians. There was another team of about 15 folks from Honor Flight that helped make the whole day run smoothly. We had 4 bus loads, all culminating in a final Heroes Welcome return to Syracuse Hancock, where I conservatively estimate a couple thousand people showed up to cheer these men and women on, many of whom never did receive the Heroes Welcome that they were rightfully owed coming back from conflicts like Korea and Vietnam. And it was my pleasure to document the day via Facebook, both photos and videos, and then finally live streaming the final ceremony. And thankfully I actually did live stream because PBS's broadcast cut off right when the ceremony started. So we actually had quite a few folks tuning in from all over watching the ceremony. But it was a great opportunity. And a side note, Mr. Hudson, our bus driver for the day, out at the airport, that's him. He's also a veteran, so it was perfect timing, and it was a great honor for him to be a part of that too, getting folks to and from the airport terminal, especially in the evening when it was raining sideways. So. Thank you very much.
Thank you. And there you go. You see.
It's Chris and Jay. A little pixely because it was the video, but.
I'd like to thank Jackie Masengo, her husband Chris, for representing Centro. I had a prior engagement that day. Chris was out of town at a conference, but Jackie and Chris represented Centro. We have been part of this honor flight for years, and we are going to continue to be part of it as we honor our veterans. All right, next thing, Caitlin, I'm going to put you on the spot a little bit. As we do every year, April 22nd was Earth Day. We have a great team led by Kate and Bren, Julia, Nate Dow, and Kate, take it away.
Yeah, so this is our 3rd year of cleaning up the surrounding community. We made a little bit bigger of a square this year. We cleaned from Portland all the way down to South Ave. And then we also started up here on Utica, over Midland, down to South Ave, right? We went over to South Ave, and back. So we cleaned up a lot of trash. We filled up the back of the buildings and grounds truck. And you can see here we group with the Southside Community Group, so it's a ton of different organizations within the Southside community. That is our group this year. I think there was probably 7 or 8 other organizations that we cleaned up with. So yeah, our turnout this year for Centro specifically, we had 5 or 6 more people this year. We had about 55 people last year, about 60, 61 this year. So every day or every year our numbers are growing. We get a huge turnout from the maintenance department, a good turnout from admin as well. So next year we're going to work on getting the drivers in there with us too. So Yeah, it's great, and everyone has fun. It doesn't sound like a lot of fun going around and picking up trash, but it really is a really great opportunity to, little Timmy, to hang out with your coworkers and do something nice for the community. So it's a blast.
Yeah, it's a great event, and again, we just wanted to highlight this to let the board know that we are out in the community. We do care about our community, and Central's going to do whatever role we can. Julius?
I'd like to ask you a question. Next year, I know the TNT program, we had, hopefully, I don't think it was part of yours.
Okay.
Hopefully, I want to make a suggestion maybe next year we get TNT and other training.
Yes, absolutely. We are always looking for more organizations. Southside really is the one that heads up the larger group, but we have a contact over there, and I could absolutely ask her to reach out.
TNT is part of this school area.
Yeah, yes, absolutely.
That way you have a combination with them also.
Yeah, that's a great idea. Thank you.
Thanks, Kate, and thanks again for your team and the sustainability team organizing all this. It was a great day. Moving on to my report, as I do every month, I outline where we are in our COVID emergency funding. We did not draw down anything in March, so we are still at about 11 million of the 38 that's available. NIFTA meetings on March 21st, I had a virtual meeting with the board of directors. We were very active in February and March, meeting, working on our budget asks for our statewide delegation. As of this morning, there still is not a budget. My estimation would be that there's going to be another continuance. They're close, is what we're hearing. I did reach out to some of our local representatives and had some conversations last week. They're hopeful that this will get done quickly, and I think probably one more continuance of the budget deadline is going to do it. And at that point, we'll know where we stand with our STOA funding. Reconnecting Communities grant, the City of Syracuse was a successful bidder on Reconnecting Communities. Central is going to be a part of that. Part of their grant application was they had to show that they had other, support of other community organizations. So we will be contributing some time to this, not so much money, but we will be a partner with the city on the Reconnecting grant, and it's always good to be working with our community partners. March 31st, I met virtually with Bishop Colette Matthews-Clark, was on the board of the Rosemont Gifford Zoo, and Carrie Large, who's the executive director of the Friends of the Zoo. We had a very productive conversation. Again, this is us, partnering or at least discussing with community groups and about the service that we might be able to provide to directly to the zoo, and those conversations are going to be ongoing. Department of Transportation, April 12th, I had a monthly meeting. Again, we're very active with DOT, myself, Bill Carpenter, from Rochester, discussing transportation needs overall and our budget asks as well. April 18th, we had our quarterly meeting with ATAC, which is our Accessible Transportation Advisory Committee. We covered a number of topics, new drivers and what we're doing to hire and retain, future transit changes, access to the ETT survey. Brenda's going to be talking a little bit about that in a few minutes. Some service work, preliminary talks with Micron and how we're going to service that facility as it begins to be built, and then they also wanted some information on the impact of the I-81. So it's, as always, very productive. We have an active group that brings us ideas, and we're always welcoming those. That concludes my report. I'm now going to go into our senior leader report. Christopher.
Thanks, Brian. Good morning, everybody. Just to highlight an additional off of Brian's comment of being out of town in the last week, Joe, Jeff Hoff, and myself were at APTA, which is out in Minneapolis, significantly colder than here, for the APTA Mobility Conference. Typically, we go to these conferences, we talk about them regularly, a lot of new products and exciting things that we were able to see out there, set up a couple demos, is actually as soon as next week, somebody reaching out to us on some products. for our customers as far as digital signage, on-time performance signs, things like that we could work on and include in some of our future products. Very educational, a lot of information, again, some products that we're looking to demo as far as some new upgrades to side view mirrors. One product we have on demo actually on property now, and then some other products that are coming down the pike. Some benefit to that is if approved by DOT, would remove the side view mirrors, and it would actually use a video mirror with a monitor inside the bus. Although it's additional technology, it saves us from smacking mirrors on random things as we drive down the street or other buses. So it's about $1,000 a mirror. So we think in the long run, the return on investment could be beneficial. And it'll also free up some space in the garage as far as spacing between buses. So a lot of new things, additional things, and hopefully some products to come to improve our service to the community. And I think everything else will be covered by the others if there's any questions.
And that side view mirror technology too is, does a lot to eliminate blind spots too. It's much more visible, the entire side of the bus, the roadway, everything, so it's.
What kind of cameras are on the buses now versus like what we have in our cars? The cars are just amazing.
So currently the cameras we have are just regular cameras, surveillance type cameras that are on the inside and the outside of the bus for a total of 11 or 12 depending on the bus. But this new camera, right now it's an additional camera based on the program we're testing. There is another product that integrates with the existing cameras, but it's just, there is an option if you wanted to add a rear view backup camera, but we don't encourage backing up in a 40-foot bus.
Now with buses, yeah.
So
But even to see visually
yeah, right
what's
now,
around you.
nothing is, this would be the first thing that would be to give the driver real-time surveillance to the exterior of the bus. Currently, everything else is DVR recorded for potential review after.
so it's
depending on the
basically
situation.
old
Yeah,
technology.
we're not looking at anything real-time.
Okay.
So these cameras with the camera mirrors would be positioned just like your camera, or just like your mirror on your car. So, you know, as you're looking to the right where your mirror would be, you're now seeing what video is showing what you would see in the regular mirror. So it gives you your blind side convex mirror and then your flat mirror. So it would look very similar to what our buses have now. It's just now video versus the mirror.
And then do the mirrors fold in if you were in a tight spot?
These do not.
Oh.
The cameras are higher on the bus, and it would eliminate the need for the mirrors.
But there is some review that needs to be done by the Department of Transportation to approve a vehicle not having side view mirrors. So that's still a thing. So right now, anything we test would have both mirrors. So if somebody's not used to it or not, you know, doesn't care for it, at
Until
least they still
learn.
have the regular mirrors.
Or get used to it.
Yeah.
Okay,
And that
thank you.
feedback would also, you know, involve in our research to say, is it even something we want to pursue? You know, if we find drivers aren't really comfortable with it, we wouldn't force it upon them. You know, that's the case. So
And that's gonna be part of the survey process that Chris
Yeah.
is talking about in our presentation to DOT, is getting driver input on how this helps or hinders, actually, so we want
Right.
that feedback.
Okay, thank you.
You're welcome.
Anything else?
All set.
Thanks, Chris. Jackie?
Morning, everyone. So, I'm sure all of the board members and some of the salaried staff that meet the threshold probably received a reminder from New York State Commissions on Ethics. They used to be formerly JCOPE. Their new name is now New York State Commissions on Ethics. And the FDS filing is due on Monday, May 15th. Just a reminder to everybody who's here today, any board members that are not here today, and all of you also, I will be sending out another reminder from my email, that way in case you think it's not a legit email coming through.
So we have to do those once a year?
Once a
Yes.
year, yes, but once you've
If you do it electronically,
Yeah, I was gonna
it's
It's a fill-in,
there's
has
an
anything
option you can
changed?
fill, so you can fill last year's
Yes.
into this year's electronically, and then as you go through, you can make edits if there was changes to your specific situation, that way you're not filling out the entire form.
Putting down my salary from Central, okay.
You gotta put your Central salary down too.
Don't forget to add the
That has
extra
to be
zeros.
zeros.
I was gonna say, and any of you, if you have any questions, please,
Yeah.
reach out to me. I'm available,
Jackie's
so-
here as a resource if you can't, if you're having trouble
I know,
doing
Julius, we
electronically.
got you covered.
It's kind of panicking when
It is,
It doesn't
it's a
look
daunting,
official.
it is a daunting form, and, there's a lot of it's written in legalese, sorry. but-
Well, it's
And like,
bad.
I was gonna say, and like Neil said, I mean, the emails that come across don't
Yeah.
appear to be.
Well, I actually dismissed it, because I did this last
See?
year.
Yeah.
And I went and found last year's, and okay.
It is an annual
Yep.
requirement, so Jackie's very good about getting notices out, and then she also gets a report of who has and hasn't, so she will follow up, so that we are 100% compliant.
Yeah. Okay. Next, we had our second annual, well, I don't wanna say annual, we had our second open house at Centro at the end of March. Even though it was kind of a dreary day out and raining a little bit, we did have 60 candidates who showed up for that event. Maybe one of the candidates you may recognize here.
Yes!
Yes! Yes, I did, yeah.
I'm a rock star with my grandson.
Great. I can attest, I was a passenger of the bus, Chris was his instructor.
He only almost hit the window once.
It was a nice ride.
It was
Yep.
his 40-foot break. Those are dimensional.
We're still trying to get them to join on board,
You know what? I'm handing back in my city ID to the school district, so I don't know. I might have an opening.
No, it was a very good event. From this event, we actually hired 8 bus operators or trainees. So that's always good from our standpoint. We started a new class on Monday, April 17th. In that new class, we have 14 trainees in the Syracuse area. We have 1 in Oswego, 1 in Cayuga, and 5 more in Oneida. So right now, we're looking at 21 that we're training.
You say 8 out of the amount of people that apply. How many? 8? There's only 8 that.
8 from the 60 that showed up at our open house were hired. So.
Yeah, and that's a testament actually to Jackie's team. We are not just accepting everybody. This is not a five-man situation. So her team goes through. There's interview process, background checks. We're really looking for the people that want to be professional bus operators and make this a career. So that's why actually these events are important, because you start out with a funnel at the top, and you're really looking for the best to come out, so that you have a meaningful class, and we can continue to grow our ranks, so that we can do all the initiatives that myself and Chris have been talking to you about over the last couple of years. And,
Yeah,
we need operators to do it, and her team's doing a fantastic job.
Thank you, Brian.
Julius just need a license.
Come on, you can come out of retirement and drive a bus.
I don't think so.
You want to take a scooter? I mean,
I'm waiting for the scooter.
All right.
Any questions? That concludes my report. Thank you, everyone.
Thanks, Jackie. Mike Fitzgibbons.
Recruit that guy.
I'm trying.
Good morning, everyone. How you doing?
Good morning.
Morning.
It's Friday, isn't it? Well, we hired someone to start doing our help desk stuff, Billy Green from Oswego. So Carlos can now do some more, the other stuff that we're looking at. And Carlos did. For the cybersecurity program, we had a meeting with the team this past couple of weeks ago. And laid out, setting up a baseline and looking at some metrics that we want to do, and kind of got the team to buy into the whole process. So the whole team is doing it, so thank you, Carlos. And a couple other notes, we're still doing our upgrades. We got some desktops that we've been replacing. We're going to be doing some more replacing out in Oswego or in the Utica area coming up. And then also working on taking a look at our closets. We have closets in Oswego and Auburn that are literally water closets. We're going to try and get the data sets and move out of those as before. That's it for my quick report. Anybody has any questions?
Any IT questions for Mike? Okay, thank you.
Thank you.
Jeff.
Thank you, Brian. Good morning, everybody. I wanted to talk to you about workforce development, and
look blurb from their website. Workforce Development, what we consider as WDI, is a statewide nonprofit that works to increase opportunities for New Yorkers to succeed in the workforce. They use a range of tools, including workforce expertise, data analysis, and flexible funding to facilitate projects. Now, we've been using WDI money for many, many years, mainly to train staff. We have Cummins coming out. We've had transmissions, training them how to work on them, fix them, brakes, AC, sending over to tech schools. It's been very useful to keep our technicians and mechanics up to par on what the latest and greatest. And then we can also purchase tools and computers to keep up with everything. We can only have one project open at a time. So if we get somebody in training, we'd have to complete that and then submit it back to them, get reimbursed. The reimbursement can be anywhere from 50 to 100% reimbursement, and then we're on the hook for the rest. Once that's complete, we can go on to the next project. Now, they did, when they came out and talked to us, they offered something new, which is child care subsidy for employees, which I thought was really interesting. I wish I had more of these I can hand out. I can pass this around. But what it does is if somebody meets the criteria, and the criteria is within the county, if they're in Onondaga or any other county that they cover, children are underneath 13 and working a minimum hours of 10 to 25. It depends on the county you're in and what they require, and then a household income that falls under the income guidelines. And then all you got to do is scan the QR code, apply, and they can get subsidy. And from what I'm hearing is it could be, a monthly fee for them would be $10 to $25 versus, hundreds. We've had employees had to quit due to the fact they weren't making enough money because of childcare.
Are you gonna have it on central website?
Most likely, yeah. Once they get out here, they're gonna be here on May 9th to do a presentation to all employees. And that's all I have. Unless you have any questions.
Any questions for Jeff? Thank you, sir.
Thank you.
Steve?
Good morning, everyone.
Good morning.
At the end of, we are at the end of the fiscal year, so I'm going to give you an update on where we stand from a ridership perspective. As I've been updating you during the course of the year, it's been about, city services are now about 60% of where they were pre-COVID compared to fiscal year 2020. Overall, we're at about 70% of where we were for that same fiscal year. Year over year, we're up about 30%, however, system-wide from where we were last year. So we are continuing to trend in the right direction. And as I've said over and over again, it's going to be a long, slow process. Hopefully, this time next year, we had another 5% gain on where we were from pre-COVID. That's what I'm hoping for, maybe a little bit more. But it's, part of that's going to depend on our ability to get services back on the road, specifically in the Syracuse area, where we're just still where we were from March of last year, at about 70% of what we had on the road pre-COVID. And that leads me into our equity analysis that was part of your board package. As a requirement from the FDA, because we've reduced some services for more than a year, even though we were hopeful of returning these services to higher levels, we were not able to do so. Therefore, many of these routes, there were 11 in total, tripped what we consider a major service change because the reduction of the service was greater than 25% of what was on the road previously. So having to be at the point where we're not able to put those services back on the road, we were required to do a equity analysis. Of those 11 routes, there were 3 of them that tripped the disparate impact or disproportional burden. But when you look at the system as a whole, and what we did is we did the equity analysis on a holistic standpoint of where did we affect individuals, we did not trip those levels. So, we're confident that what we did, it really wasn't what we could do about it. We had to make some changes to mitigate the services here. We're going to do the best we can to return services as quick as we can, specifically on probably urban bus routes most quickly. So after the equity analysis is performed, the board needs to make a motion that they acknowledge acceptance of it, and then we're going to have to schedule a public hearing probably in May or June, just to let the folks know that our intent is to bring most of these services back. nothing we can do about it right now until we get more people behind the wheel. It's something that a lot of transit agencies across the nation are going through the same situation where we are, so we're no different than others. So with that, I would need a motion from the board to accept the equity analysis.
Have you had any feedback from writers where you're not going anymore?
Yeah, we still have some feedback. You know, when are you going to go back to what was before? I missed a particular trip that I'd like to use. Not a lot,
Yeah.
not as much as I would think. I think some folks after a couple of years have made alternative
Yeah,
plans. But I think if you return the services to the street, the more frequency especially, people will then learn back to rely on it. It works for me, I can now use this as I used to.
Any businesses?
Pardon me?
Any businesses with feedback, with employees?
We always get businesses that are, you know, can you change it, can you tweak the time? You know, everyone wants to have the bus
Yeah.
arrive at their place 5 minutes before the shop opens, and,
You
you know,
can't do
but,
that down the street, yeah.
yeah, but, you know, Micron, obviously something in the future we're looking at. We added some services back up along the Lloyd Road, Cath Road area as well. Places we didn't serve, prior to, you know, the pandemic, so. That reverse commute, getting people from, the city of Syracuse out to suburban locations is something that we will look very hard at through the reshaping of our services.
We are providing quite a bit to Amazon too, on Morgan.
Yeah.
Yeah, as in-
Yeah, Amazon, that particular route, when you look at it, you know, the weekend ridership is double. And the weekday ridership on that route is up probably about 30%, and it's Amazon driven.
Yeah.
How many drivers are we down now?
How many drivers are we down? 40?
Still between 40 and 50.
Yeah. Yeah, it's.
You know, the challenge is, Julius, you know, we're bringing on these classes of, you know, 12 or 14, but then through normal attrition, retirements, you know, if you bring on 15 but you lose 7, you got a net gain of 8. It helps, but we really need to start getting those net gains of 10, 12, 14 so that we can get back to our full complement. Once we're back to our full complement, you know, and if there's any silver lining in the equity analysis that was done, it's that it is allowing us to take a step back, look at the entire system as we begin to implement BRT, and that increases frequency. We will be able to then take a look at the entire system, branch out from that, and really start servicing these areas and put core service out where we need core service and getting people to work. I mean, that's what we need to do. Anything else, Steve? You want
With that, we need a motion for the board.
Tina, second. Monty, all in favor? Opposed? Motion approved.
Thank you. At this point, I'd like to bring Lynette Paduano forward, our Director of Marketing Communications. One of the things that we do every day is we're active on social media to outreach to our community, our riders, stakeholders, so they understand exactly what we're doing from a global perspective and from, you know, the micro perspective. So with that, I'll turn it over to Lynette for she'll give you an overview of how we did during the past year.
Thank you, Steve. Good morning, everyone. Each year, I am tasked, one of many things, with preparing an annual social media report that summarizes all of the analytics associated with our online post activity. And this year, Brian asked me to come and share all of that information with you, so here I am, and here we go. Next slide, please. So Centro, or at Go Centro Bus, as we're known in the social media world, made its debut in April of 2014 on Facebook, Twitter, and YouTube. We joined Instagram in 2017, followed by the LinkedIn launch in 2021. Next slide. And this past year was fantastic. The pandemic put a little dent in our post activity, but this was a great, great year. Our engagement was strong, reactions were plentiful, the communication was very active on all the platforms, and most importantly, we grew our followers on every single one of those platforms. Next slide. How? How do we do that? Well, this last year, we posted 1,008 unique messages on our social media sites. And they had the goals of engaging with the community, building brand advocates, and most importantly, driving up the ridership for Centro. And some of the action items that we took to help us achieve those goals were sharing links to service and career information that directed folks back to the Centro website where they could access additional details, fill out applications. We uploaded videos of our employees doing their jobs, showcasing them. People, we're showing what we do. We featured our internal programs, the RPM program, which we're all gonna participate in hopefully after this, along with a lot of community involvement and engagement activities with outside agencies such as the Salvation Army, Shades of Inspiration for a breast cancer awareness campaign, the St. Patrick's Day Parade, which had great attendance this year, and agencies sponsoring job fairs like Jubilee Homes and CNY Works. But while we were doing all of this, the most important part of this, we had to pay close attention to the conversations that were taking place on all of those platforms as a result of what we were posting out there. And why? Why would we do that? Because those conversations are very, very important. They tell a story. They share the thoughts of our riders and the community. What do they think about Centro? What are they saying? They provide insight and answers to the challenges that we're addressing organizationally each and every day. And whether that chatter is positive or negative, it provides us with something very important, and that's feedback. And as you all know, feedback is critically important to the success of any organization. Next slide, please. So did all of that pay off? It did. It really did. And as you'll see by the percentage numbers there, Facebook, Instagram, Twitter channels grew 11, 27% respectively. Our YouTube subscriber rate was up over 28%. And look at that. Oh, by the way, LinkedIn number, 133.72% growth. That was outstanding. Now, that's all great. You may be wondering, what the heck did you do, Lynette? What was going on? What was behind all the numbers? It's your lucky day. I'm going to show you. I have an amazing team in marketing. Casey Brown, who you all know, and Rachel Bachman create a lot of the artwork and work right along beside me, and we're a great team. We have a lot of fun. So I'm going to take you through the top performers of the 4 quarters of this past fiscal year and show you a little bit about what we did. So, first quarter we saw the highest activity response rates, and our analytics showed us that we had big spikes following launch of our Amphitheater Express service, our service change announcements, welcoming our new drivers to the organization, traffic advisories associated with local events impacting our buses, recruiting, most definitely, a lot of activity there, along with community events. The big one was at NBT Stadium, where we partnered with the Salvation Army and the Syracuse Mets for Stuff-A-Bus, or for the Juneteenth. Stuff-A-Bus is coming. And this was a great opportunity for us to bring folks to the stadium, to provide some ride service, and to really get out and engage in activity and conversation. Next slide, please. Second quarter, the travel training program is back in full force, and Roger Thayer and his team got very active out there, so we showcased and reminded the community that we do offer that very important service to those unfamiliar with Centro. We had the Christmas in July, again, was a sponsorship of the Salvation Army and the Syracuse Mets. We took a bus out to the stadium and filled it with back-to-school supplies. We asked folks to drop things off on their way inside. We had some first pitches. Brian did an interview in the press box. Chris out on the field with some of our RPM award winners throwing first pitches out there. So it was a fun day. Employees also participated in there, and we had a great time, and got donations of school supplies for Salvation Army. 440 Game Day Express with SU also, a lot of activity around that, along with our recruiting events, the New York State Fair, of course, the Park and Ride Express service, and our 50th anniversary happened this past year. So we had a lot of online activity associated with that, sharing factoids with everyone. Next slide. The third quarter was the announcement of our ETT initiatives, our public transit reshaping. So Exploring Tomorrow's Transit was, if you look at the analytics on that page, and all of you that follow can pop on there and take a look, off the chart spikes. The community is interested, they're listening, and they're paying attention to that. We, again, educational campaigns and timeline initiatives associated with 50 years of Centro. We've done a lot of things over those 50 years. Our RPM award programs, recruiting events, again, featuring why it's good to work here, along with great salaries. We have amazing benefits and a lot of fun things that we do organizationally with our employees. Our Breast Cancer Awareness Month campaign was a great success also. Donations, very high. We delivered a check to Shades of Inspiration. There's a photo there of us delivering everything we collected along with the check. They were very appreciative of. And that bottom photo there is the Stuff Bus with Walmart, again with Salvation Army, where we collected toys and clothing items out in Cicero for the Christmas holiday, Christmas Bureau season. Next. And last but not least, the fourth quarter was our open house in March. Our BRT announcement, and I think Brendan's going to get into these a little bit more. Our Lights on the Lake was a huge success. Everyone had a great time on that. All 5 of those events were very well attended, and the kids had a great time, and as did Centro. Our St. Patrick's Day Parade, first time ever, the employees marched along with the buses there. So you'll see that photo of all of us. Frank got some of the union crew together with us, and we all joined arms and had a great, great time. So thank you for that. Recruiting initiatives, again, because it's so important, as Jackie and her team know, to get folks inside the door. And our Ride Pass campaign. One of the things our customers struggle with is understanding the right pass for them, so we launched an educational campaign to help them learn a little bit more about what we have to offer in terms of products. So as you can see, it was a very productive year. Next slide, Carlos. But in closing, I'd like to leave you with one last thing, a quick update on our professional networking career development site, which is LinkedIn. We officially launched that in April of 2021, and it really was launched to help us address what is currently and likely our biggest challenge, which is recruiting and retention. And as the statistics showed earlier, we grew our following on that platform, and that's huge. That helps us. How? It allows us to post jobs, network with area professionals, interact with job seekers and agencies, join and participate in Q&A sessions, build on and protect our reputation in the community. So people want to work for an organization that has a good, positive reputation in the community. And that's the job of the marketing department here. We take it seriously. I know Chris and Brian have expectations of us, and we hope we deliver on those each and every day. And as I said, at the end of the day, the result was positive, and hopefully HR is picking up some of our work there. 133.72% increase in following. So.
I'd like to ask
Yeah.
you a question. That's great. Are you familiar with the STAND program in media on Savannah Street?
Yes.
Do you do a lot of free advertising? You do free advertising with STAND?
We don't do free advertising with them, but we can.
Because that might be a good thing, either if you have some, like I got the post some brochures that
Sure.
postal methods, like Southwest
Absolutely.
Henderson, Northeast, places like that. You can post them out.
You're awesome. You have all these great connections and ideas, so
I need
yeah.
to work with them, huh?
Yeah, let's chat. Any other questions?
I'd like to thank Lynette for that presentation, and it's also important for me to point out to all of you, all the graphics that you're seeing, this is all done in-house. We have a great marketing team. They create wonderful graphics. It's user-friendly. And this is how we are getting Centro's positive message out. We are involved in the community, and we're going to continue to be. So thank you to Lynette, Steve, Casey, Rachel, and Alicia.
One other thing I'd like to point
Thank
out
you
with
so
our
much.
social media outreach is the communication that it stops sometimes, and that is because it was a year in which we have human resources really was a large portion of what we were doing. For our riders to be reassured and see that we are holding these events, they understand that we're doing what we can to get operators. And without social media, it would be just a vacuum. They would be on the buses not knowing what's going on. But they can see the open houses and they can see the commercials, and it's reassuring not just to our riders but to the community members that we are doing everything we can in our power to restore service and get people in the building. So, anyway. At this point, I'd like to turn this over to Brent Dice to give you our monthly update on our special projects, I think specifically ETT. Thanks, Brent.
Good morning. So I will be brief. I know it's been a long morning, but wanted to give you a couple updates. First, exploring tomorrow's transit. You've been hearing me talk about it. It is going well. We've got over 850 responses to our survey requests. We've had events where folks can just come out and talk to us and ask questions. There's no formal presentation in those events, but they've been going well. And again, over 850 responses. So we are doing well on that. Now, the survey is due to close in mid-May, so I brought my little cards along with me again today. If you and your teams live in this area, work in this area, fill out a survey, pass it along to your folks. It doesn't need to be folks who ride the bus. It needs to be folks who could ride the bus. So we want both riders and non-riders. So I'll leave this here for you, and I may hand it to you before we leave today. And the other thing I just wanted to talk about briefly was that we are working with area high schools on outreach and communication. So this semester we're working with Chittenango High School. They are in the metropolitan area, and we're working on a project-based learning class. It's a senior level class, and it's really designed to teach the students real world business situations and let them feel what it's like to have an assignment and follow it through. So we're working through the project scenarios in a professional setting. I've been to Chittenango. They've been here on our campus visiting and got a tour, spent most of the day with us, and it was a great visit. We toured the facility and some buses. We spoke to Centro staff members. They got to speak, I speak to Centro staff members all the time. They got to speak to Centro staff members and learn about our technology and our service platforms. And it's really about, giving them exposure to what a transportation authority does, why we're here, why providing public transit is so important. And so this semester they are working on 2 projects for us. They're thinking about a community bus, so what would a community bus look like? And they're thinking about solar energy and what would that look like at a bus stop. So they're in the middle of doing that research for us, and they'll have some reports to give us at the end of the semester. But just wanted to point out that we're doing some cool stuff with some area high schools and want to continue that. It's been fun. So.
And I'd like to point out the ETT survey. I mean, this is the basis for what we're doing here at Reshaping Centro. I'd like to thank our partners at SMTC. They're doing a great job. They're the ones that are going to be ultimately gathering the data and presenting it back to us so that we can make some very informed decisions on where we need to take this company in the future. So thanks, Brad. I mean, you're doing just a fantastic job with that.
Thanks.
All right. Mr. Chairman, that concludes our senior staff, but I am going to go right into Mr. DeGray. For those of you that know Joe, Joe's not a fanfare guy, but I think it is important to point out that he is retiring We will have more to come on this maybe at our next meeting, but this will be Joe's final report as Senior Operations Vice President. And you know, that's going to leave a big hole, but we are, I'm confident we're going to fill it, and again, we'll have more information at the May meeting on Mr. DeGray. But
Hold your applause till the end.
Thank you very much.
Don't be so cheerful, John.
2 hours and 14 minutes. one right now. Thank you, Mr. Brian, Mr. Chairman. Quarterly call of us report for the end of the fourth quarter as well as the end of the fiscal year. We're up again. The quarter was 40,315 rides across the 4 counties. About 1,200 customers, so our customer base is starting to grow a little bit. So we're up about 22%. The one nice thing is we're not comparing COVID numbers to new numbers. We're actually doing year over year now, so hopefully we won't have to discuss that anymore. The fiscal year total was almost 152,000 people. So that really puts us back to where we were, what we would call a normal situation or a normal year. Oswego in particular is way up. We're up about 50% there. We're up about 40% in Cayuga. Now, granted, these are percentage numbers, not great volume, but still, it's a big swing that we haven't seen in quite some time in those areas. So, you know, part of it is obviously availability. Part of it is people are living longer, and part of it is people are needing that service in a greater percentage. So, I would expect that. I would hope it kind of slows down a little bit, but at this point, we're still keeping up. Do I read that? And doing a good job. The last part that I would like to mention is we have finally fully staffed back in Columbus with our customer service agents. That has taken a while. It's taken a lot of all the other departments as well. You see a lot of new faces here all the time. It's difficult to hire right now. And fortunately for us, we've been able to fulfill all the seats that are down there, and hopefully we can maintain and retain those employees. Thank you.
Jill, I just have to say, as much as I rag on you about Columbus, you've done an awesome job.
Thank you.
I'm so pleased. The wait times are down. I was remembering olden days when sometimes you'd be on for 40 minutes waiting for somebody to pick up, like back in the 80s.
Oh yeah, I remember that.
What we don't forget. But no, I know you don't get enough thank yous, but as a person who sits in a Columbus almost daily, thank you. You've done an awesome job.
Appreciate it. Thank you.
And to conclude my report, Mr. Chairman, I would also like to take just a quick opportunity to recognize Pat Harrington. Pat is, as many of you board members know, she's the face that you see when you enter the building for your Friday meetings. Pat has been a wonderful employee, 24 years as a part-time receptionist in at our front office. Like I said, she's the one that greets everybody. Pat will be retiring June 2nd. We want to wish her well and thank her again for 24 years of service.
Thank you all. This is really bittersweet, let me tell you. It's a tough decision, but I think I am the oldest person in Central, right?
I would never say that,
Pat. I think I am. Well, first I retired from Verizon, which was Bell Atlantic at the time. So I had 25 years there. Stayed home with my daughter when she went to school. Thought, well, I'll just go back. I need something to do. So it's been fun. I've enjoyed. I just love all of you. This is tough, I'll tell you. I used to ride the buses with my dad. He retired from Syracuse Transit when there were the old diesel buses. You know, I used to ride around the city with him. So we've come a long, long way in this company. Unbelievable. But I have such ties here, and it's tough. But Jeannie Barankovich says, Pat, we'll call you back so you can sell tickets at the fair. You know what that is? Okay, so I says, yeah, keep me in bank. Nobody ever leaves, I swear, Brian. Everybody's back part-time, you know? So you know what a great company this is.
It's just a testament to what the company is.
I mean, you got LMA coming back, and you know, it's just
hard to leave, boy, it's tough, but I think it's, if I have another 20 years, I'll be lucky, so I better go enjoy myself. And I got grandkids, and I volunteer at the Eastwood American Legion. I do paperwork for Gaming Commission for their bingo, so I'll be busy, but I'll be back.
But who's gonna run?
Thank you all for the
Who's gonna run the
acknowledgement.
front like that?
What's that?
You're the perfect front runner in the front. You just
I know.
after the first time you met me, you remembered who I was,
Yeah,
and
yeah.
that meant a
Tina.
lot to me.
See, I'll be a good bartender at the Legion right there. So anyway, yeah, thanks, folks. It's been fun, really.
Thank you, Pat. Appreciate
Yeah.
your work.
Yeah, thank you.
All right, Mr. Chairman, that concludes my report. We can go into Audit and Finance Committee.
Brad's gonna have to get the mallet out, because I'm gonna deviate a little bit from the script. I've been on the board a long time, and this is nothing negative about the past. Meaning all the boxes were checked, all the numbers balanced, all the safety audits they did great on. However, recently, I'm really impressed with the way management is being done. They're doing a very good job improving morale. I sat in an executive meeting and somebody said to me, "This is a state authority." And I said, "No, it's an enterprise. You have relations with the vendors, you have relations with the employees, you have relations with the people, because when people come to work, they feel better. And that shows to the customers, to the politicians, to the public." So I think we're on the right track, and thank you, Brian, and thank you to your staff for doing that. And I heard one word today about the Earth Day, fun. I saw the employees, pictures of the employees picking up garbage aside of the road, but they had fun. That means Monday morning, they like coming in. I'm sure a lot of municipal and state agencies don't do that. And the people come in Monday morning and go, "Oh, when's my retirement?" So thank you, Brian.
That's just Joe. Thank you, Bob, for those comments. We do work hard. We work hard at, involving everybody, being out in the community. I'm very pleased that you're noticing that, and we're gonna continue. And if there's more opportunities, we're gonna take advantage of those as well.
I'm glad that you're moving in that direction, Brian, because I deal with a lot of the senior citizens. They're still in the analog, is that the word? Analog concept,
Yeah.
instead of the digital. Sometimes I talk with them, they seem to don't know what's going on, so we're gonna have to make a big effort to reach some of the senior citizens more too.
We'll certainly work on that.
Okay, this morning we had an Audit and Finance Committee meeting, and motions were sent for board approval. Motion 4A is to, do I have to, can I do more?
Whatever order you like, but don't.
I won't forget. Suburmation Refreshments, we approved the contract to go to them. I need a motion from the board. Darlene, second. Joe. All in favor?
Aye.
Motion passed. Next, there was a motion to award to Crown Risk Management for the workman's compensation. Any questions? I need a motion to approve it. Tina, second Darlene. All in favor? Motion carried. Motion 4C to award the Shepherd Brothers in the amount of $126,691 per vehicle, and $1,646,983 for a total of 13 buses. Tina? Second.
Just one of my call buses.
But you can't make the first and
She
the
wants the
second.
second.
You can do just one or the other.
Any opposition? All in favor? Motion carried. This is
This is a fare box replacement.
fare box replacements. And we awarded it to Genfair.
They are a sole source, so it's important to note that.
And we have experience with them.
We do.
I need a motion to, Julius, second. Loretta? Luella, sorry. All in favor? Motion carried. 4E is the amendment to Greyhound on the lease agreement. It really doesn't cost us any money. I need a motion. Neil, second. Luella. All in favor? Motion carried. And then, the insurance. Motion to approve the automobile and general liability insurance, which was presented by John Mayloff. I need a motion. Darlene, Neil, second. All in favor? Motion carried.
I had a couple of
And then Linda does have a couple of announcements to make under audit and finance as well.
So, I just wanted to inform the board of a couple, promotions recently. Melissa Brim was promoted to Senior Director of Accounting earlier this month. So in her new role, she'll be taking on the payroll function and also the revenue collection department. And also Caitlin McCullum was promoted to Senior Director of Procurement. And in her new role, she'll be taking on the, direction of the storeroom, parts inventory storeroom, which is responsible for all the parts, for all our locations. So congratulations to you both. That's it.
I can't help myself, but in the past, the way the numbers were presented, yes, they were accurate and they were, they were the right numbers, but your presentation now is much different than in the past and much better.
Thank you. We appreciate that.
Much better understanding for those of us who are not number people.
We try.
Next, we need a report from Joe Hardick from the legal committee.
Thank you, Mr. Chairman. The legal committee met this morning in executive session to review a specific case, and no action was taken.
We also had a pension committee meeting. Alesco Advisors gave us a detailed overview regarding the authorities' returns, allocations, and a very good market discussion. We also heard from the actuary, which in my opinion, with a defined benefit pension plan is really important. He did a very good job in my opinion, and he updated us on actuarial assumptions for pension plans. And basically that was a very good statistics course. That concludes my pension report. And then now we're going to the nominating committee report.
Thank you, Mr. Chairman. The nominating committee met earlier this week. After a discussion, the committee is advancing the following slate of officers for the 2023-24 fiscal year. Chairman Nicholas Leano, Vice Chair Robert Kukulish, Secretary Darlene Latmore, Treasurer Tina Fitzgerald. It was recommended to move this to the full board for a motion to accept the slate as presented. I need a motion.
I motion, accept the slate.
Marty, a second. Julius, all in favor?
Aye.
Motion carried. No old business?
No, sir.
And no future business?
Not as of right now.
One future thing, have Central participate in the TNT program coming up. Hopefully that.
We're slated to be at the meeting coming up
On Monday.
Yeah, Monday evening, we'll be there along with SMTC. So, yeah, I'm looking forward to it.
That concludes our meeting.
Thank you again, everyone, and a reminder, we have staff that can lead you down to where our, we transform a corner of the garage. It's a fun